assets at the predetermined price.
So basically here, that provides the buyer the contract, the right, but not an obligation, which means you get a right, but you don't have an obligation to exercise the right. So I gave an example of a dollar where the dollar went to 73. So you said, okay, I'm not going to exercise my right. I'm going to lose just my premium. So you are allowed to do that. To purchase or sell the underlying asset at a predetermined price. So you fix a price today that I'm going to buy, say, dollar at 75. Okay. But if it happens that the dollar goes to 73, and as you are an importer, so you are not going to basically exercise your right, because it will become a very costly contract to buy the dollar at 75 when it is available in the open market at 73. So you are going to walk out of the contract and lose your premium, and then you are not going to exercise this thing right. But in case if the dollar goes to 80 bucks, if the dollar goes to 80, so Chandra, would you exercise your right to buy the dollar at 75 in that case? Or you're going to walk out of the contract? What are you going to do? Chandra? Should I repeat my question again?
Yes, sir.
Suppose you are an importer and you are going to make a payment, say, on say 1st of April. Okay, again $1 lakh. So you entered into an option contract, okay, for buying dollar at 75 rupees. Okay. Today it is 74. Now on the 1st of April, the dollar is selling at 80 rupees. So in that case, what you are going to do? Are you going to exercise the right? Because you have got the right, but not an obligation. So you can simply either walk out of the contract or you will exercise the rights. So what are you going to do if the dollar touches 80 bucks in the open market?
Sir, exercise the
right.
rights.
Exercise the right. In that case, you will get the dollar at 75. Okay. If you have gone to the open market, you got the dollar at 80 rupees. You would have lost 5 rupees per dollar. So you would have lost about 5 lakh rupees. Okay. Fine. So is that clear? Okay. Fine. Read further.
Based on the option type, the buyers can exercise the option on the maturity date, European options, or on any date before the maturity, American option.
So basically, in options trade, we have two kinds of options. One are called the European options, other are called American options. In India, we follow European options. So option type, both buyer can exercise the option on the maturity date. So that means if you have taken an option contract, you can exercise only on the maturity date. Okay, so that is prevailing in India. So we follow European options. But if you are not in India, in your, say, in other country, maybe in America, there you can exercise the right anytime before the maturity. Now, what is this? We'll understand when we do options more in detail. Okay, fine. So I'm not going to explain that as of now, but it will come. Time will come when we'll go into this more in detail. Okay. Swaps, I'm just skipping because swaps we'll be doing in our next semester. So Nikita, can you just read these swaps?
Yes, sir. Swaps are derivative contracts that allow the exchange of cash flows between two parties. The swaps usually involve the exchange of a fixed cash flow for a floating cash flow. The most popular types of swaps are interest rate swaps, commodity swaps, and currency swaps.
Okay, fine. Since we are going to do only in the next semester, I'm not going to dwell on swaps at the moment. Okay, but I gave some example of credit default swaps in the time when we started understanding these derivatives. So I'm just skipping it at the moment, but in next semester we'll be doing interest rate swaps and commodity swaps more in detail. Again, this fixed and floating cash flows also we are going to do in our next semester. So let's talk about now futures and options market. Nikita, can you read?
Sir, do you mean financial risk management or any other subject?
Financial risk management, FRM, which is your second part of the semester, isn't it?
Yes, sir.
So have you taken FRM in the next semester?
Yes, sir, have taken.
So we'll be covering that time. So don't worry. Okay. Nikita, can you read?
Yes, sir. Futures and options market. Futures and options are stock derivatives that are traded in the share market. It is a contract between two parties for trading a stock or index at a specific price or level at a future date.
So basically, future and options are stock derivatives. that are traded in the share market. So you go to the share market to enter into these contracts. So whether you enter into a future contract or an option contract, so these are derivatives. For that, you have to go to the stock contract. So it's a contract between two parties for trading a stock, okay, or an index. So you can, there is here basically you can either buy a stock or an index itself. Okay, like you can buy a Nifty, you can buy a Sensex, you can buy a bank, a pharma's index, okay, for example. Okay, so you can buy even an index also in the future and option market. But in the cash market, you can't do that. Okay, you can't buy Nifty because Nifty is not tradable. It's just simply an index. So whereas in futures contract, you can, take a bet on the index itself. Okay, so it is basically, taking a bet. So you're taking a bet on a stock or an index. So that is allowed only in the future and options market. So as I told you, there are two kinds of market. One is called the capital segment of the market, which is the cash market, and the second is the futures market. So in the first market, you pay money and buy the stock. Okay, but in futures market, which is a separate segment of the market, where their prices are different than the cash market. So we'll understand that. Okay, read.
By specifying the price of the trade, these twin derivatives safeguard the investor against future fluctuations in the stock market.
So basically, again, this is being used for hedging, okay, or for speculation. And we'll do some examples to really understand, how the hedging happens, basically, and how people make money by speculating on either a particular stock or on an index. Okay, so as of now, some examples we'll be doing to understand both basically the hedging as well as speculation in our next, this thing in this lecture itself. Okay.
However, the actual futures and options trade is often far more complex and fast moving.
So basically, it's a very complex trade. So we'll have to understand more in details, and we have to focus a lot to, and though it's very easy, it's not like very complex, but some people find it complex. Okay.
While futures and options through a trader, it is always advisable to understand their functioning before you invest in them. Here's what you need to know.
So, you can, use a trader. So we are using basically ICICI Securities or any, trader you can use who has got a license. Okay. So because you can't have a direct access to the stock exchange, it has to be done through a online trading platform. Okay. So we will visit that very soon.
NSE commenced trading in derivatives in 2000.
So basically, the National Stock Exchange started trading in derivatives in 2000. So they started this activity in 2000 itself. So it's not long ago. It's about 22 years back only the derivatives traded started happening in India. Okay, it was happening earlier, but in different format. But it was the Bombay Stock Exchange, which was started much earlier. So there it comes much earlier. Okay.
Two major products under equity derivatives are futures and options, which are available on indices and stocks.
So basically, you can take a bet on either an index or a stock. So there are called equity and basically futures and options derivatives.
Futures and options on individual securities are available on securities.
So basically, they are available on securities because individual securities, like we will have two kinds of rate. One in the cash market, one in the futures market, the same stock. Okay, so we'll understand that very soon.
The exchange has also introduced trading in futures and options contracts based on indices. Currently, derivatives on Nifty 50, Nifty Bank, Nifty Financial Service, and Nifty Midcap Select are available for trading.
So basically, index trading also happens, and they are available today on Nifty 50, Nifty Bank, Nifty Financial Services, and Midcap. Okay. So we'll go into that more in detail. Okay.
Individual securities futures. The futures contracts are available on 197 securities.
So there are about 5,000 shares in India. So out of that, only 197 securities which are available on futures. Okay. So let's see what are those basically. So can you see the Excel sheet here?
Yes, sir.
So basically, this is the list which I, found from the stock exchange. Okay. So these are the underlying, okay? These are basically the shares, okay? The first share is Aarti Industries, Abbott Industries, ACC, Adani, Aditya. So these are all the shares, okay? So if you go down the line, there are about 197 shares, okay, which are currently being allowed to trade. So it's 193 at the moment, okay? Fine, it keeps changing, okay? So these are all the stocks which are available. All the stocks like Reliance, Tisco, Tata Steel, HDFC Bank, all are there, okay? Fine. And each stock is given a symbol, okay? So these are the symbol. And there are 3 months of, trading happens February, March, April. So you can take positions for 3 months. So we'll understand that, okay? And then there is always a lot size. So we'll understand these concepts in my coming slides, which are there, and then we'll revisit this, okay, again. Okay.
Individual securities futures. These securities are traded in the capital market segment of the exchange.
So basically, all these securities on which the future on options happen, they are also traded on the capital market. That means in the cash market. So in the cash market also, you can buy the securities or the shares. In the futures market also, these securities can be bought. So there's an option either to take a bet on the cash market, or you can take a bet in the futures options market. Okay. So that is called the capital segment of the exchange. All these securities which are generally traded, where you buy them, they'll come into your demat account and you have to pay 100% price. Whereas in futures market, the rules are different. Okay, you enter into a contract. So we'll understand that. So trading cycle.
Trading cycle. Futures contracts have a maximum of the 3-month trading cycle. The near month 1, the next one 2, and the far month 3.
So basically, whenever you enter into a contract, so now basically the contracts are available for the month of February, March, and April. So the February month is called the near month. The next month is March, and the April is far month. So you can take a bet on any of the month. Okay, so maximum contracts will be in the month of February if you have to just go to the stock market. So almost like 70 to 80% of people would be betting on the month of February, and then balance will be either on the month of March or April. So you can take a bet anytime. If you think Reliance is going to go up, in next 3 months, so you can even buy a contract which is going to expire in the month of April. Okay, so we'll understand more in detail. I'll take you to the stock exchange. Okay, yeah.
Expiry day. Futures contracts expire on the last Thursday of the expiry month. If the last Thursday is a trading holiday, the contracts expire on the previous trading day.
So basically, there is an expiry date. Whenever you buy a contract, it will expire. It will expire on the last Thursday of the month. Okay. If the last Thursday is going to be holiday, then it will be the previous day. So it will expire on Wednesday. Okay. So further, then I'll just. Yeah.
Contract size. The permitted lot size for futures contracts may be stipulated by the exchange from time to time. Reliance lot size is 250.
Now, basically, this is a little riskier game. So that's why, the stock exchange doesn't allow, they have fixed a lot size. That means people who have deep pockets, they can only venture into, these kinds of trading activity. So they have fixed a lot size, which is much higher, because if you want to buy share, Reliance, you can buy even one share in the cash market. But you can't do that in the futures option market. You have to buy minimum 250 stocks. Okay. So 250 into say 2,400, so it's about 5 lakh rupees money, which is you are actually playing with. Okay, so Reliance has 250. So similarly, other stocks like Maruti has a lot size 100, Tata Steel is 450,